Thank you, Lisa.
All right, good.
Thank you, everyone. It's a pleasure to be here today. I'm going to talk about a few key things in this discussion. I'm going to talk about the manufacturing and risk outlook in a time of uncertainty. And I also want to talk about the case for developing supply chain risk management strategies. So first, let's talk for a second about what's going on in the US and globally with manufacturing. We'll start here, and then we'll go through a number of different topics. So first, global purchasing manager indices are the most important leading economic indicator of the economy, and they are a critical real-time gauge of what's going on in manufacturing. Now, occasionally, when I give presentations, I'm told I can only have one slide, and when that's the case, and I have to talk for sometimes an hour or more, this will be the one slide that I choose. Unfortunately, I have a number of other slides I can talk about, but on this slide, you see three lines. You see a red line that's pretty close to the axis right now. You see a green line that's been strong but has recently fallen. And you see a blue line that's at very strong levels. That blue very strong line is the US ISM Manufacturing Index. It's a survey of purchasing managers at manufacturing companies who say their business is expanding this month compared to last month. 50 is the break even for these. So when the number's above 50, that means that more people are saying that manufacturing is expanding. More purchasing managers, the people who buy real stuff in manufacturing companies, are buying more this month than they were last month. And that's because they have orders to fill. And when they have orders to fill, they place the orders, the things have to be shipped there, and of course, when the orders are completed, they go into GDP. That's why it's important for growth. Now, the green line, which had been very strong and has recently fallen, is the Eurozone manufacturing PMI. Still above 50, that's still good. Now, the third line is the Chinese Caixin manufacturing PMI. Now, this is a privately compiled piece of data. It is actually the only data point that we watch out of China. And in a number of recent quarters, we've been ranked number 1 or number 2 in the world for forecasting the Chinese currency. And I will tell you, this is the only economic data out of China that I think is valid. The reason is this is a privately compiled survey of small and medium-sized manufacturers. We think about data coming out of China, we think about Chinese manufacturing, what's going on. Well, you can't really trust a lot of the government numbers, and there's a government PMI, and that number is for large manufacturers and it's government data. That's not great. But the privately compiled one, I put a lot of faith into, and I'll talk about why in a minute here. But the most important thing to know is that there are a few recent dynamics. Between December of 2014 and June of 2016, this number was below 50 for 18 of 19 months. In other words, there was a Chinese manufacturing recession between December of 14 and June of 2016. The second thing you should know is that it had expanded since then up until September. And throughout this year, it had been slowing. In September, it was at 50, a break even, indicating that Chinese manufacturing did not expand in September. In October, it was at 50.1, barely eking out any growth. This is really important because China consumes the majority of the world's aluminum, a plurality of the world's copper and steel, and is the biggest source of additional marginal future demand for oil. And China is the biggest net importer of crude oil. So if you ask me about commodity prices, the reason I can talk about this graph alone for an hour is because that Chinese number will tell you what's going to happen to commodity prices. The blue and the green line will tell you what the European Central Bank and the Fed are more likely to do. And in concert, these three numbers, even though manufacturing is only 11% of the US economy, still leads what's going to happen with overall growth. The other thing to consider in the global economy, as we want to know what's going to happen with manufacturing, right now in the U.S., we see a strong expansion. The Eurozone, it's slow, but it's still expanding, and China is break even. And by the way, China's probably at risk of going back below 50 in the immediate term. This is a direct result of what's going on with the U.S.-China trade conflict. If this trade war continues, China is very likely to slip into a manufacturing recession in the immediate term. That is bearish for industrial metals prices, with perhaps the exception of domestic steel, which I'll talk about in a minute. And this is going to be the number to watch. Now, for the IMF's global growth numbers, the IMF and the Fed played a little bit of a game for about 6 months. The Fed's still playing it. The game is, let's not talk about trade risk. This is a very academic exercise. Back in March, Jay Powell, new chairman of the Fed, at his inaugural press conference, was asked questions about trade. What about trade risk? And he said, this is the Fed. We don't do trade here at the Fed. And the Fed then raised its expectations for future Fed funds rates in March, July, and September. The IMF acknowledged the risks in July, but didn't put a number on it. Or actually, they acknowledged them in April, didn't put a number on it. In October, they said the trade risks could be 0.5% off of global GDP. But they didn't actually bake it into their forecast. In October, they lowered their global growth forecast from 3.9 GDP growth for this year and next year down to 3.7. That's what triggered the global equity market sell-off last month. It was fundamental, and it was a real downshift in expectations of global growth. The reason the trade issue is so important is because of this graph. The red line that you see at the right that's spiky, that was world trade in 2017, at the end of 2017. That really strong trade helped growth last year achieve a 3.7 growth rate. But if trade weakens, that presents downside risk. And the other thing I point out is that regardless of what was going to happen in the midterm elections and what has happened in the midterm elections, there will be no change likely in trade policy. Because there's one fundamental truth that most people don't know, which is that the president has tremendous, almost unilateral authority to make tariff and trade policy. The number of legislators the president needs to discuss trade policy and tariff policy with is 0. This is one of the things I talked about in my book, Midterm Economics, which there were a number of copies handed out to folks yesterday when they checked in, but I've also unlocked as a free Kindle download until tomorrow. So because I'm here and I'm talking about some of these issues, I figured if you want, you can download the book for free at midtermeconomics.com, or you can find it on Amazon. So here's the thing though, gang. The 3 biggest risks for the next 12 months for manufacturing and for the economy in general haven't changed either as a result of the midterms or as a result of anything else. The risk is only increasing. And those 3 big risks are the tariff and trade policy is unstable and difficult to predict. The second factor is that monetary policy operates independently of the government, and there is a tightening bias. And the third thing is that national debt is likely to continue to rise further. This presents risks to interest rates. This presents a very big risk to interest rates if the U.S.-China trade war gets worse, right? Because the Chinese are our bank, right? They buy a lot of our debt. They finance the short end of the curve. If the trade war worsens, they don't need to sell our treasuries, and they probably won't because they lose money on it. But let's just say they skip a few treasury auctions. Short-term interest rates would go up quickly. One fund that we advised said to me recently that could be like 6 Fed rate hikes at once. Now, that's probably a bit of hyperbole, but directionally correct, right? So there's real risk at that short end of the curve. So against those backdrops, what's the outlook then for manufacturing and interest rates, and how does this all fit in? So consumer inflation is above the Fed's target of 2%. The red line on the graph is the 2% Fed rate. We're above the level. The Fed's talking a hawkish game on interest rates. Producer inflation, which affects manufacturers more directly, is closer to 3%, especially goods inflation. If you look at goods inflation, that's even higher. That's closer to 4%. The goods line is the blue dots on this chart. So these are elevated levels of inflation. Now, while the Fed's most concerned about the consumer, this erodes corporate profit margins. This is a challenge. And you add to this then the Fed's desire to normalize policy. And right now, these are the Fed's current rate hike expectations. They're basically expecting to get these numbers to happen by the end of 2020, you'd need 5 more Fed rate hikes from where we are right now. That's the Fed's own forecast for what interest rates are going to be. I expect we get a rate hike in December. I expect we get a rate hike in Q1, and then I think they're done. Last October, we'd forecasted 4 interest rate hikes this year from the Fed because we saw a base effect, right? Inflation was really low last year, and so even just kind of normal inflation could pop you above 2 this year, and we expected high oil prices during the summer because we believe this would be the biggest, baddest driving season in history, and it was. But now, oil prices are under pressure. Why? Because the biggest net importer of crude oil in the world is at risk of sliding into a manufacturing recession. This also happened, by the way, at the end of 2014. When China slipped into a manufacturing recession, oil prices fell. People kept talking about shale. It wasn't about shale. It was the demand side. The demand side evaporated. Now, this time around, it might be a little different because OPEC and non-OPEC members are working together to try to keep oil supplies in check so that inventories don't balloon, because that's what they did in 2015 and the early part of 2016. Inventories ballooned up because China was in a manufacturing recession. Now, as for an overall economic recession, our clients have become more optimistic about 2019, but more pessimistic about 2020. Every quarter we ask our clients, which is a largely industrial base, so automotive parts manufacturing, oil, gas, pipelines, logistics, transport. We ask them, when do you expect the next recession? In July, 47% of our clients expected it would be in 2019. In October, that fell to just a little over 10%. But the expectation for 2020, over 80% now expect a recession in 2020. The important thing to consider about the overall economy are 2 things. One, there was a recession of business investment in 2016. Business investment contracted. The entire economy was still in good shape because the consumer is 70% of the economy. And with a 3.7% unemployment rate, the consumer might be able to carry us through any kind of downside risk, or at least mitigate a lot of it. The second thing to know is that in the third quarter, the most recent GDP report, there was a contraction in non-inventory business investment. In other words, business investment's already contracting right now. So what happens to manufacturing could be very different what happens to the overall economy. Overall GDP growth next year could be 1.5%, something like this. But in manufacturing, there could be a recession. Again, that's because 70% of the economy is the consumer. Something we started doing a couple of years ago to kind of illustrate the risk across industries was to create a slide where we identify some industries where we see where are they on sort of a scale of strong expansion to deep recession, and then kind of a break even in the middle. This is our analysis going into 2018. I think this is played out roughly right, where we saw a little downside of construction. Housing has slowed. It was strong early in the year, but we're seeing housing slow. We saw construction slow. Those numbers took a hit in Q3. As we look at 2019, we see more risks, especially for construction, for housing, for autos. And by the way, construction isn't just housing. We're talking also structures, right? So any kind of structures, any kind of construction faces downside risk. Autos face downside risk. Industrial goods face downside risk. We've also said that metals and mining face downside risk. And exploration and production and oil field services could have kind of a mixed year in the year ahead. Because if China goes into a manufacturing recession, there's a lot of downside, but there are some upside risks, like if OPEC and non-OPEC members continue to keep their hand on the rudder and keep inventories tight, and if there are still some other supply disruption risks from, say, Iranian sanctions. Those things could keep us kind of in a choppier kind of dynamic for the year ahead. But things like the consumer and e-commerce and non-durable goods, those are going to have probably still very good years next year. Same thing with industrial technology. Anything on the technology side is going to continue to probably do well as long as there's an ROI tied to the tech. Now, as far as market risks go, what is then that outlook, those risks with China, the risk of higher interest rates? What does this mean for companies? What does this mean for markets? So let's talk about some market risks. So steel prices, which already were triggering buy signals last October, those have been very strong this year, largely as a result of the Section 232 tariffs. Those prices are likely to remain elevated, but we think they're going to fall a little bit over the next couple of years, and this is for the hot-rolled coil Midwest price. So even for the U.S. price, we see some downside. Aluminum prices are highly dependent on China. Again, China consumes not a plurality, a majority of all the aluminum in the world. Aside from a big price spike kind of in the middle of the graph, which occurred around a U.S. sanction issue around Rusal, the price has been really under pressure during the year. Oil prices, they've had their biggest losing streak in history, just going on right now. Why? A couple things. Oil prices follow aluminum prices. This has been going on for many years. Again, it's a demand side issue. Aluminum's gotten crushed. It was only a matter of time before oil did. During the driving season, we expected high prices. We acknowledged downside after that. Now, there's two other lines on this oil price chart that are important. There's a little blue line that goes across and a blue line that goes up. The diagonal blue line shows when oil prices started rising in the middle of 2016 after the Chinese manufacturing recession ended. It's been largely on an uptrend until a week or so ago. The blue line that's flat goes all the way back to December of 2014 when China slipped into a manufacturing recession. So we just barely went above that number at the beginning of the year in January. We were above it for the first time since December of 2014. And now we're back below it just in the past week. You can see it a little bit better on this graph. This is oil prices. You can see if we played a game, pin the tail on the Chinese manufacturing recession that happened at the end of 2014, you can see the drop on the right-hand side. That's that Chinese manufacturing recession. U.S. economy was fine. Eurozone was fine. China in recession. And now, here we are falling back below that same blue line. It's the same line from the previous graph. So prices are likely to be in flux, and the demand side is going to be critical. The PMI is going to be really important. This is going to have a huge impact on businesses that are in any kind of fabrication or production of any of these goods. For companies that consume these goods, you can expect to see potentially some reduced price pressure, but it will depend where the goods are coming from. So tariff issues, if you see goods coming in from China, still present some risk. Now, this has added, and there are some other wrinkles to this, the third quarter GDP report, huge bump in inventories, a huge drop in net exports. In other words, we're importing a lot of stuff, and I know there have been a couple panels that have talked about these comments. You're seeing these movements through the supply chain that are creating bulges in response to uncertainty of policy. a number of years ago, I did an executive ed program up at MIT with the Center of Transportation Logistics, and they played a game with us, as I've since learned they play with most grad students and a lot of executives, called the beer game. Anybody here played the beer game before? Okay, so the beer game is you have a bunch of people at a table. One of them is the beer manufacturer, the brewer, and the end is demand, and in between you have wholesalers and distributors in a chain. The brewer has no idea what demand is going to be until a certain number of turns have passed. But everyone in the chain has to guess what the number is going to be. And so what invariably happens is the folks in the middle who are waiting for a number of demand guess too big because they're trying to make up for the number that they think might come, but they also have no idea what's coming from the factory side. So you get this two-way supply chain, and no one knows what's going on. This creates what's known as a bullwhip effect. With a bullwhip, if you've ever seen, a small flick of the wrist results at the end of a really big crack. And this is what happens in the supply chain. You end up with these bulges, and you end up with imbalances, and people don't know what's going on. This is something that can add volatility to, I don't know, freight rates, maybe, you think? So people don't know when they're going to get the stuff. Suddenly they get the stuff. They have to move the stuff, and it has to be done quickly. So as we think about risk in the year ahead, there's already plenty of reasons to be a bit concerned about what's going on with freight prices. You know, these are the LA to Dallas prices. The year-over-year rates are up this year something like a staggering 36%. And you can see that there's these risks from peak to peak, but trough to trough, they're also up. But aside from the prices might just go up, you end up with things like Atlanta to Philly, where you get higher highs and lower lows. So you get these really big pushes and pulls, and this is likely to persist in the year ahead. What's gone on in the third quarter, which could likely happen again in the fourth quarter, is you have importers trying to get goods in before tariffs go on. Now, I have clients, and there's a lot of folks who'd like to think that maybe the China-U.S. trade situation will be solved as easily as the U.S.-Mexico-Canada agreement seems likely to play out. The NAFTA 2.0, in the end, the U.S. has a little bit more access to dairy markets. There's a couple changes to IP. There's sort of a sunset because there's a time limit on it. And there's a little bit more automotive content for parts, and wages around automotive are changed. These are small things. But if you want to know what's driving the U.S.-China trade policy, it's interesting. There's a book about this. The U.S. trade czar, Peter Navarro, wrote a book about trade policy, and it's actually being done now. It's quite subtly titled Death by China. So if you think this is about getting American access to Canadian dairy markets, that's probably not on the same level as Death by China. One of the chapters is Crouching Tiger, Nuking Dragon. Can't make this stuff up. So the book, which has the subtitle of A Global Call to Action for Confronting the Dragon, has a laundry list of things the U.S. should do or needs to do in the view of the author to address certain imbalances with China. It's a laundry list of things that have been recently done and are probably likely to be done further. This means that the U.S.-China trade situation might not unwind itself very quickly. This is the trade czar, after all. This is really important to consider as you think about risks to, what does that mean then for Chinese manufacturing, to oil prices? What does this mean for flows of goods through the economy, for freight, right? So these kinds of risks are going to become likely more volatile because, as I mentioned earlier, the number of folks the president needs to consult about U.S. tariff policy is 0. Which brings me to a couple thoughts on risk management. And one is thinking about what risks you have is really important. but also deciding what you want to do with that risk is equally important. I've advised a number of companies on this for years, both in this role and when I was a risk specialist at McKinsey before I founded Prestige Economics. And it was always an issue that sometimes people didn't understand what risk ownership meant. If you have a freight business and your business is to get goods from here to there, right? If you're in trucking, transport, logistics, the question is, do you want to be in the oil business? Because if you don't, that's a risk that you don't want to own and you probably should look to mitigate. If you're an international firm that imports trucks, what you want to be doing is buying low and selling high, right? Businesses never go broke by making a spread. I realize we could discuss what's going on in the tech market and maybe we'd have disagreements about what the market looks like it accepts. But generally speaking, buy low, sell high. You want to make a spread. If you import trucks, you don't want to worry about your currency rates. If you're transporting goods, you don't want to worry about your fuel. And I find particularly interesting, what the folks at FreightWaves are doing with freight futures in the year ahead as a way to also transfer that risk out, right? So, and I know you've probably heard about this today, but the 7 different lines and the 4 different regional contracts are another way to offset risk. And to make that decision, you really need to ask yourself, do you want to own that risk? Do you want to be exposed to freight rates, or do you just want to be responsible for getting the goods from here to there and locking the prices in? I would also share what most people don't know about hedging is that funds and corporations tend to do staggered hedges. So they tend to lock in the most exposures for various things up front in the current quarter or the next quarter. But as you look further out, you tend to manage and hedge less of your risk because you want to be exposed in case the prices go down. Now, just to recap the sort of economic risks and exposures to manufacturing and the economy moving ahead this year in 2019, what do we see, right? The good news is the U.S. economy has been expanding. Consumer confidence is strong. The ISM manufacturing index is solid. U.S. economy looks pretty good. Global economy has been expanding. It's likely to expand, but I think the IMF may lower those growth outlooks in the not too distant future. And the third thing is that Chinese manufacturing recession ended in June of 2016 up until September of 2018 when growth stopped. That number is the number to watch. As for the risks, top risk, trade and tariff risks, those are big. Labor costs, that market is very tight. Labor inflation costs are the highest right now since, I think, April of 2009. Year-on-year wage rates, that's going to be a big corporate profits challenge moving ahead. Inflation, that's elevated right now, but we think that base effect comes down, so maybe 2 Fed rate hikes instead of 5. But monetary policy is still likely to tighten. Chinese currency war is also on. It's not a coincidence that the Bank of China has coincided some of their rate cuts because the Bank of China is not independent, right? The Fed is independent. And no matter what anyone says, if the Fed wants to raise rates and the Fed decides to raise rates, the Fed will raise rates. The Bank of China is an extension of the government, and they've had cuts in their interest rates coincide exactly with tariffs being applied. Emerging markets, those risks are also exposed. If we think about the global economy and a supply chain, the U.S. and the Eurozone, we buy stuff. China makes a lot of the stuff. And China buys raw materials from commodity-based economies. So if you want to know about manufacturing, you want to think about the global economy. If you think copper and aluminum and oil are at risk, so are all of those countries that produce the raw materials that go into the supply chain. And finally, I'd say, obviously, auto sales and housing are at risk. And I think freight cost volatility is likely to remain high, where you could continue to see either higher highs or a mix of higher highs and lower lows. Just really big bullwhips as people have trouble kind of predicting what's going to happen with the supply flows, and companies try to get ahead of tariffs, which could then result in a big drop-off next year of imports. Here's our disclaimer. I know you're going to read it diligently. And now that you got it, you can download, again, a free copy until tomorrow of my book, Midterm Economics. I talked about it on Bloomberg and CNN, and you can download it, and I hope you enjoy it. And thank you very much. Thank you.